Okay. Well, good morning, everyone. My name is Denise Kranich, and I am the Director of Development for the Medical Society of Virginia Foundation. I am very excited to have one of our 2020 annual meeting and gala sponsors, Truist, host this morning's webinar. The MSV is pleased to welcome Rick Blackwell and Emily Dunstan to discuss the importance of financial planning in a changing market landscape. I would like to take a moment now to introduce Emily Dunstan. Emily began her 18-year wealth management career with Truist in 2003. Her role as a medical client advisor in Truist Medical Specialty Group exclusively serves physicians and their families. First and foremost, the Medical Specialty Group was designed to support busy physicians and help them manage their financial lives by simplifying the delivery. Simple point of contact, expanding the platform, more than just banking, and rewarding physicians and practices we bank with relationship pricing. As a medical wealth advisor, Emily and her team provide specialized lending and mortgage solutions, review insurance policies, and manage investments. With those services comes personalized private banking. Financial planning is the foundation from which we render service, and Emily and Rick have partnered together for 12 years. Emily resides in Henrico County, Virginia, with her daughter Amelia and their golden retriever Volley. In her spare time, Emily serves on the board of the Westwood Club, enjoys playing tennis, and spending time outdoors throughout the James River Park system. Before I turn it over to Emily to introduce Rick, I want to go over a few housekeeping items. If you would like to ask a question, please utilize the Q&A function at the bottom of your Zoom screen. If your question is not answered, please email the MSV team at memberservice@msv.org. Again, that's memberservice@msv.org. As with all of our webinars, this session will be recorded and posted to our website. On behalf of all of the membership and the staff at the Medical Society of Virginia, I would like to thank you for all taking the time to be with us this morning. And I will now hand it over to Emily and Rick. Welcome.
Good morning, Denise. Thank you so much for hosting us today and for having us. And it's a pleasure to be here. We've been partnering with the Medical Society of Virginia since 2004. On our legacy SunTrust side of the bank, now Truist. And I have, as you mentioned, been with the bank for 18 years. Part of that time was with BB&T, where I had the opportunity to work with Rick. And one of the things that I do for our clients is help expand the bank for them and bring content and thought leadership that would be applicable to our physician clients. And Rick is one of my partners in that area, and I've worked with him for a long time. Why I work with him, I think, is important, especially for the content of this call. I can count on Rick to do what's right for my client. First and foremost, he's going to listen and understand what our clients' needs are and work with me to develop a plan that can work for our client over the short and long term. The second reason I work with Rick is his honesty and transparency. I think that is really important when you're trusting someone with your largest asset. In many cases, for our physician clients, their investments are the biggest portion of their overall net worth, and it's important to have trust and honesty and transparency in the relationship of your advisor. And then the last thing should come across today in Rick's talk is knowledge of the market and understanding of the economy and how things work together. And I think the competency that Rick has is really important for his clients. So those are the reasons why I work with Rick and why I've had a partnership with him for so long. And with that, I will turn it over to you, Rick.
Thank you, Emily. I appreciate that introduction. Is my sound coming through all right for you? Good. Okay. Well, I appreciate that, Emily. It's been a pleasure working with you for a very long time at BB&T and now with Truist. And it's a pleasure to be here with you all this morning. So I appreciate the invitation. My team, the Lewis Group of Truist Investment Services, actually put this presentation together specifically for this morning. customized to the importance of financial planning in a changing market landscape. We've also put some very specific information for medical professionals in here. I should share that I am married to an emergency physician. So as a professional financial advisor and living with a doctor, I can relate to a lot of these topics, and I hope that this will be, getting close to home in areas as we move through this presentation. So I'm a longtime WebExer, first-time Zoomer. I'm hoping that we have technical ease through this. Just hang with me, please. If we get caught up anywhere, I'll get the sound coming back and get the slides moving. Here we go. All right, so this is my team, the Lewis Group. We are 9, and we work very hard with our clients to be a personal CFO. So I have, on a day-to-day basis, interaction with people in all professions who are working toward retirement, in retirement, from everything financial planning through portfolio management and cash flow management. My team here is available to you if at any point in this presentation you want to jot down some notes and follow up with us. You'll have a copy of the slides. You can call, email. We would like to certainly take this offline and help you. So I'm going to start off with some very specific planning considerations for medical professionals. Then I'll move through some economic and market information and come back around to looking at the proposal in Congress right now from President Biden, what the tax impacts of that may or may not be, and then some specific planning items around that. So this is at a high level, 5 key considerations for medical professionals. The first is, and you can, I'm sure, relate to this, take a wellness approach to your finances. So think about your financial health in the same terms as you might think about your personal well-being. A big part of that is setting checkups, setting regular check-ins at intervals to make sure that you are hitting the milestones you want to hit and doing the things you need to stay financially healthy. Working with an advisor is a great way because they'll kind of nudge you and remind you on that. But set a personal financial meeting every year, even if it's just with yourself, to sit down and think about how am I doing, what am I doing, and am I on track? The next thing to consider here is developing and maintaining a financial plan. Now that term, financial plan, can really be intimidating to a lot of folks who have either tried to start one on their own and got stuck on the budget, or have just never tackled it because looking at the checkbook is not particularly fun. A financial plan doesn't need to be a lot of heavy lifting on your part. Emily and I help design these on a regular basis. And what we do is help you get organized, help you think about the future, and then start looking at what are the success probabilities of different courses that you could take. And then we advise you along the way to make the moves that approach that plan incrementally, gradually. So it really is not a point-in-time exercise, but a lifestyle of having a financial plan and adhering to it. An asset protection plan is really what I'm talking about here is insurance, and there are various types of insurance. So first and foremost would be property and casualty. That's something you have to have if you're driving a car. But extending your home and auto into a personal liability umbrella. Looks like I'm losing my connectivity here. Emily, can you hear me?
I can hear you.
Okay, great. So making sure that you have a personal liability umbrella that is equal to or greater than your net worth. So if you think that you have approximately $1 million net worth, you would want to call your homeowner's insurance company and make sure you have a liability umbrella of at least that much. They're very inexpensive, very easy to obtain. And they protect you if somebody were to, say, have an accident at your house or many liabilities you might encounter in a non-professional setting. On top of that, you want to look at your professional coverage, your malpractice, and specifically for medical professionals, your disability insurance. Having a long-term disability policy that is own occupation, meaning it will cover you if you can't do your job, is very important. If you have the wrong disability coverage, I'm sorry to tell you, you could run into a situation where you're unable to do your specific profession, but the carrier tells you there are plenty of jobs you could do. And of course, the income situation would be different, but you may not be able to go on claim. So check your disability, particularly your long-term disability, for own occupation rider. It's very important. After you are through an asset protection plan, start thinking about your priorities for your free cash flow, meaning you are reaching a point in your career where you make more money than you spend, and you'll have to think about, do I pay off loans? Do I pay off my mortgage? Do I start saving? And really, what is the right answer in most financial planning contexts is you want to do some of each. You want to reduce your debt, start with the highest interest debt that you have. Usually leaving your mortgage for last is a good rule of thumb because much of that interest is tax deductible. And then at the same time as you're reducing debt, you want to build up your retirement nest egg and qualified accounts like your 401k or your SEP or your profit sharing plan, depending on how your employment structure is organized. And outside of that, save in an after-tax account. It's like a bank account. Could start out with a bank account. After you start exceeding 6 months of your spending in that account, you may want to work with a financial professional to design an investment strategy. So really doing all three of those, retirement savings, taxable, flexible savings, and then reducing your debt at the same time is generally good advice. But again, specific to your situation, Emily and I would be happy to help you come up with a plan on that. And then finally, and not by any means the least important, implementation of an estate plan, a will, a medical directive, and a durable power of attorney are the three key parts of a basic estate plan. And then, of course, as you accumulate assets and approach retirement, there may be more complex estate plans that are appropriate for you, like the use of trusts, life insurance trusts. It all depends on what you're trying to accomplish. It's one of those things that we don't like to think about, but all the work leading up to that item is somewhat lost if you don't have clear intentions outlined in a good estate plan. All right, I'm going to shift now into some slides on the economy and the market, because I think for some of you that's going to be as interesting as hearing me talk about planning. This is just a quick snapshot of where we are in the market year to date over the past year. And then I really focus mostly on the 10-year numbers in portfolio management. So very strong year through the end of March, and we're higher than this now in May. Up 6% on large U.S. stocks, 12% on small stocks, and I'll talk about that in a minute. Just 3 on international, and then bonds are negative. If you look out to the 10-year numbers, you'll see that U.S. stocks have averaged almost 14% for the last decade, while small cap stocks have slightly lagged that. And international, though, these are companies in, say, Western Europe that make products we all use, have not produced much more than a third of the return of the United States over the last 10 years. This lag over that long a period of time is unusual historically, and we believe in our portfolio management today that international developed stocks have potential to outperform the U.S. over the next 5 to 10 years. As we manage portfolios right now, we are overweight stock. That's partly driven by very low interest rates and the fact that bonds are not appealing to produce positive returns ahead of inflation. And we're using some alternatives like gold or real estate investment trusts or preferred stocks to take the place of the bond allocation that you might hear by rule of thumb, say a 60-40 portfolio for someone who's retiring we might cut that 40% bond down to 20 and use 20% alternatives because we feel they will offset stock market returns and volatility, and at the same time not commit to almost the zero return of bonds over the next several years. All right, let's look at where we are economically, and then I'll talk a little more about the market and its pockets of opportunity. So this is a GDP trend line going back to 2007. You will see that in 2020, COVID knocked us off of our trend in a big way. We were starting to warm up, running above trend. That's why you saw the Fed raising interest rates 2016, 17, 18, 19. And then they stopped appropriately as COVID disrupted the economy, sent us into a bear market very quickly, and then a recession that followed in Q2 of last year. Where we are today is moving rapidly back toward that trend line. And actually a lot of economic forecasts, including Truist's, are that we will move through trend and potentially see 7% GDP in the fourth quarter of this year. That is World War I, post-World War I GDP levels. And we haven't seen that in a very long time in this country. And what the Fed's telling us is that that will be sort of a mirage, right? So if you think about it right now, if you want a car or a boat or even a washing machine, you may not be able to get it because supply chains are disrupted. A lot of households have received checks that are unspent at this point, and there's a competition for goods and services. That will work its way through the system. Those checks will probably not keep coming, and so we'll come back to trend most likely without the Fed having to act to slow down the economy. And so we feel that it's going to look like we're overheating and that the Fed could step in, but they probably won't. And that will feel like a little bit of a boom and then slow down in the economy in 2022. And will you just give me a thumbs up if my sound's still coming through all right? I'm so nervous about the Zoom. Okay. All right. So this one to me is sort of fascinating. We're comparing on the left side of this chart the economic loss of the 2008 financial crisis in orange and the COVID-19 economic loss in yellow. So you'll see, while this was an unprecedented event, we really had a quarter of the economic impact that we had in 2008, and we all remember the global financial crisis. On the right-hand side of the chart, we're measuring as a percentage of GDP the response in orange to the global financial crisis and in yellow to COVID. So we really are in a situation where we've experienced a quarter of the loss of 2008, but had 4 times the fiscal response. That's the reason that we're right back to trend in a year, and the reason we'll probably accelerate through economically. This is a look at money supply. So the multiple rounds of $1,400 checks, the PPP loans that went out and are being forgiven were created out of thin air. And we have not seen money supply like this since World War II. What you'll notice in the blue, gray, squiggly, and this is a busy chart, but I'll try to walk you through it. That's the money supply, okay? And you see a peak in money supply typically ahead of the CPI, which is the red line. So right now we have very low inflation, which is comfortable, but 2 standard plus deviation money supply spike. It is likely that inflation is going to creep in behind that. And eventually that will prompt the Fed to act and cool off the economy, but we could be a couple of years away from it in our view. All right, here we're looking at the very unusual dynamics of 2020. So dark blue line is US personal disposable income, and then the light blue line is the unemployment rate. The gray bars running up and down, we're going back to 1976, the gray bars are the recession periods. So what is typical to see is that disposable income falls when unemployment rises. And those things happen in recessions. income falls, unemployment rises. What you see out here to the far right of this chart is 2020, a spike in both. So we had an unemployment spike from shock, and then people were earning more money not working than they were working for a period of time. And so, right or wrong, that very aggressive policy response has brought both of those numbers right back in line with normal times very quickly. And that has allowed us to really pause our economy. We're not rebuilding like we were. We're not emerging from rubble like we did in 2008. We're just kind of taking off the mask soon and going back to work. And whatever you had planned before, you're probably going to do now. There'll be pent-up demand for us all to do those things at one time. So we see a very strong economy looking forward because of that. This is a consumer savings, and I'll show you how this looks for companies as well. Both companies and individuals have not spent through the cash that they accumulated. So that's on the sidelines. This shows personal savings rate in 2020 at 15%, getting money faster than it could be spent. Companies have done the same thing with their, whether it be their PPP loans or just holding back on raising dividends while things were uncertain. We think you'll see a boom in corporate mergers and acquisitions, and again, consumer spending. And we would lean into the sectors that benefit from travel, dining out, discretionary items, luxury items. We think will do very well over the next couple of years as this works its way through the system. And we think companies buying back their own stock will give a tailwind support to the stock market. Let me shift to interest rates here. There are four major central banks on the planet: the European Central Bank, the Bank of England, the Bank of Japan, and then the Fed is certainly the behemoth that most try to follow. Although you'll note Japan has really not had much choice back to 1998 because of their structural economic issues. They've been at zero or negative. But what we saw 2016, 17, 18, 19 was the Fed kind of bringing back their ammunition. It's a good thing they did because they needed it in 2020 unexpectedly. We went right back to zero, and the ECB and Bank of Japan are negative. What we expect to see on the right side of this chart going forward is low and steady rates for the next year, maybe even two, and then very gradual increases. And look at the market expectations of central bank rates in 3 years from now, so 2024, we would still be below 1% on short-term rates. So if you are hoping that the bank is going to give you a raise on your deposit, or that your CD is going to be back to 3% anytime soon, I would submit to you that you may want to work with a financial advisor to design a portfolio that can at least keep up with inflation, which we think will creep faster than the central banks at this point. All right, and now we're looking at what I'll call a yield shortage, a worldwide problem for the retiring individual. So rule of thumb used to be pile up your money, save it, and then draw your 5% interest and dividends off of it. And then the 5% became 4, and today the 4% is 2 at best if you're looking at stock dividends and intermediate term bonds. So what this means is in the accumulation phase, when you're not drawing money out, a balanced portfolio, even an aggressive portfolio, should grow. But when you get to the point in time where you need to start living on your assets, the old rule is not going to work. And you're going to need to have a diverse portfolio that includes long-term growth assets after you retire. The idea that you cash it all in and then live on the interest is probably not in our future in the next several decades. So just if you're on that eve of retirement, or even in the 5 to 10 years leading up to it, this is not a shameless plug, I would strongly recommend that you start to learn to trust a financial advisor to help you make the portfolio decisions that will carry you through retirement in a low interest rate world. All right, this is a busy chart, and I promise I'm almost through the charts, and then we'll talk a little more about you all. You're looking at, in the light blue, the market expectations of inflation 2 years from now. In the dark blue, 10 years from now, and in pink, 5 years from now. And what is remarkable about this is that a year ago, as we sit here today, the market expected negative deflation for a 2-year period of time because of the COVID shock. Over a 10-year period, the market expected inflation around 1%, and that being below the Fed target was forcing them to be on zero and consider going negative, because we don't want to be in a Japan situation where we have deflation throughout the economy. Fast forward, I'm talking 12 months, and we've seen not only all three of those time periods, 2, 5, and 10, market expectations move above the Fed target of 2%. But we've seen now short-term expectations higher than long-term. That's that sort of sugar high moving through the system that we talked about earlier. That's the pent-up demand and the saved stimulus money working through the system. We'll feel inflation over the next 2 years more strongly than we will over 10. But note, the market thinks we're going to be above the Fed target, which means the Fed will eventually raise rates and slow down the hot economy. So what do you do on the backdrop of inflation creeping in? Fed will probably raise from here, although it may be a few years. We look back at periods of time where treasury yields were increasing. So you see 1996, 98, 2001, 3, 5, and so on, right to present. And what was happening in the bond market, that's that Bloomberg Barclays US aggregate. You'll note you have always lost money in bonds while rates were rising. And then what has happened in the stock market, as measured by the S&P 500, you have made money in the periods of rising rates, and handily in most cases. So being an equity investor is a good hedge against inflation and against rising rates. So we would say, again, to our overweight on equities, we're not talking about for next month necessarily, but over the next 3 years, we think you'll be well served to be a stock investor. The Russell 2000 is small cap stocks, which tend to do well earlier in economic cycles, tend to outperform the large cap stocks when rates are rising. So just sort of some history there to think about portfolio positioning on this backdrop of rates. And then I mentioned small cap. This is comparing in blue market expectations for small cap earnings growth. And then looking back at 2020, what the market thought. And small cap is on the left, mid cap in the middle, S&P 500 on the right. So a year ago, we thought small cap would get crushed, at least we, the market. Expectations were the small cap would get crushed. And here today, it looks like small cap will out-earn large companies. That's intuitive. When there's a lot of liquidity in the system and borrowing rates are low, companies that are growing and use debt are in favorable conditions. So we would anticipate small cap, if you have the risk tolerance for it, say in your 401k, would be worthwhile to maybe add to your exposure a little bit. All right, let me switch here. Thank you for the chat, Doc. There'll be a recording. Somebody having to leave a little early. All right, so this is comparing international to the S&P 500. When the blue line is above the zero axis, it means international stocks are outperforming US stocks. And then the little blue bars are showing fund flows to or from international equities. So what you see going back to 1983 is an oscillation back and forth for international markets outperforming and then US markets outperforming. It goes back and forth depending on the global dynamics. But we have been in a period since 2012 where we're below that zero line, meaning the S&P is smoking the EFA, which stands for Europe, Asia, and Far East. Back to my very first slide, 14% annual returns for the S&P over 10 years. versus 5 for international. So we believe if you're a value buyer and you have a long horizon, that positioning assets into international markets now, noting that fund flows are still very negative, institutional investors are still taking money out, but if you buy and hold there as a percentage of your asset allocation, we think you will outperform the S&P 500 in the next 3 to 5 years. This is a reminder. I have to show this in any presentation that I do. We'll call it the Quilt Chart. So in the columns, you see the year, and then the colors are different parts of the market with their return at the end of that year. The best are on top, the worst are on the bottom. So in 2008, the best thing you could have done would have been to have had everything in fixed income. You actually would have been up 5%. And if you were all in emerging markets, you would have lost 53%. 2020, at the end of the year, small cap up 20%, REITs down 5%. Anything that was interest rate sensitive was struggling by the end of the year as rates started rising. So my point with this chart is there really is not a pattern, right? If you sat with this for days and days and tried to figure out how to use it to predict the future, you would not come up with anything with any statistical relevance. What we do know, though, is if you own a little bit of each and you, with discipline, trim what does the best after it does the best and add to what does the worst, most of the time that allocating portfolio, which is the line through the middle, will avoid the deep losses of the worst asset classes. And sure, you won't have the 79% return in 2009 of emerging market equity on your whole portfolio, but your volatility will be substantially mitigated. You'll have an investment strategy you can stick with without having to think too hard about it. And if you use a professional to try and lean in or out of where we see the opportunities by, say, adding 5% to the base allocation, over time, you should be able to outperform the markets without needing any kind of rocket science algorithm or quant formula, which I know you all are too busy for that. So keep it simple is my motto, and has served well for my 17 years of helping folks do this. Last chart, then we talk a little bit about financial planning and Biden's tax package. I hear almost every day, what are we going to do about this debt that has been racked up? And I am not here to tell you that it's not of concern or something that needs to be curbed. But today, at 140% of GDP, that's the orange line for the United States, we have the lowest interest payments we've had in decades. And the reason for that is while our debt has accumulated through these programs, the interest that we pay on that debt as the 30-year-old 16% treasury bonds have matured has dropped to point something percent, 0.7%, for example, on 10-year securities. So we can afford the interest. The Fed certainly has an incentive to keep rates low. Part of the reason that we're pretty sure that they will. And if we can grow the denominator of debt to GDP, we can grow our economy and stop spending like crazy, we come back into a more normal range of debt to GDP, and the interest payments don't break the bank. So this is probably a nice segue into some personal planning and tax commentary here, because another way that you can change the dynamics there of the debt to GDP is raise taxes and pay the debt. And we do see some of that on the horizon too. So let's talk briefly about what it means to plan. I said in the beginning, please don't be intimidated by that word planning. It's really getting organized. Then it's a fun process, in my humble opinion, of thinking about what you want to do. What are your objectives? Wedding for a daughter in 10 years, putting kids through college? Is it a travel around the world phase when you first retire young? Is it a beach house? Whatever it means to you, and believe me, it's very different to each individual. You want to think that through and then get it down on paper. And then The more time you have in advance of those major milestones, the better. Emily and I, or your financial advisors, will help you to put together a roadmap to ensure that you arrive on time with a high probability of accomplishing those objectives through the strategies that we're going to use leading up to it. So it's a guided process. It really starts with just working on a personal balance sheet, a budget, and then getting together with us to help you refine that into a forward-looking model that projects whether you're doing the things you need to do today to be where you want to be at particular points in time in the future. Sorry for the pause here. There we go. All right. It's not just about investments when you're working with an investment professional. So really, selecting investments is a byproduct of the outcome of that planning. We want to figure out what you want to do, what your resources are to accomplish it, and then with the least amount of risk possible, how do we get you from A to B? And that could mean, a specific example for a physician I've worked with is you decide to continue to own the building for your private practice through retirement, because the steady rental income on that is one of the legs of your income stool in retirement. We will customize a strategy to deliver the kind of cash flow that you need to have to stay on the roadmap that we help you lay out. And it's not a point in time, it's an ongoing process. We're going to put something in front of you that is a plan and gives you some confidence you're on the right track. But back to those wellness checkups, every year you want to look at, am I above trend? And am I not doing things that I could be doing now because I'm way ahead of schedule? Or am I falling behind? Do I need to make minor palatable adjustments to my savings or my investment strategy to catch up? And that's the great thing about once you do the initial push of having a plan, staying on track with it is not an intimidating task at all. All right, a few minutes on the Biden tax proposal. I will preface this with it is a proposal, and our government right now is divided fairly evenly between parties. So I anticipate this will look a lot different if it gets through to something that's enacted. But what you're hearing the most about is probably the least concerning to markets and to most Americans. So the top bracket income going up really just to what it was a matter of years ago from 37 to 39.6 is the major income tax hike that you're hearing about. And the long-term capital gains and dividend rates going to 39.6 from 20% affects only earners over $1 million, not people with $1 million. People who make AGI $1 million or more per year would be subjected to that higher capital gains rate. The increase on capital gains and dividends affecting most Americans would be from 20 to probably 25. It's not nice if you're an investor, but it probably won't wreck the market. So what you're seeing is when these headlines hit, the market kind of freaks out for a day and then comes back the next day because you think about it rationally and realize it's not the end of the world. We can actually digest that and handle it. Couple of other nuances in this Biden tax proposal. Income tax deductions for high earners will be curbed. That's the PEAS limitation, that restore 3% PEAS. That's named after a legislator. It's his last name. And it really means once you get into the higher brackets, you start losing itemized deductions and pay more taxes. We would see the SALT, which really hurt people in New York and California. That's the state and local tax deduction, actually come back. So that helps in some regards, but it gets capped. And probably would be one of those offsetting maybe benefits of this if it plays out exactly as it's written. And then the limitization again of itemized phase out business income deductions is in here too. Social Security gets extended to those above 400,000 annually. So it used to be you paid your Social Security up to a certain income amount, and then it stopped. It would keep going. I guess maybe good news on that is it will fix Social Security. The bad news is it would tax earners over 400,000 a lot more. Half of that 12.4% is the earner who pays. And then expansions of credits. This affects the bottom brackets for sure. Earned income tax credits, child care credits, renewable energy will be fairly interesting to see what comes through on that. First-time homebuyer credits, like we saw in 2008, will come back. I'm not sure why we need that. The housing market is in fuego, but nonetheless, it's in there. Probably will come out if I had to bet. And expanding the Affordable Care Act premium credit and a retirement savings credit. So a lot in there. I think it will get through the meat grinder of Congress, kind of merged with this Bernie Sanders 99.5% bill that he's got that addresses more of these estate tax items on this slide. So estate tax right now, if a couple were to pass away, you have over $22 million of wealth that can be passed to the next generation without any estate tax on it. We think that will go to $3.5 million per person and $7 million for a couple. Portability is retained. If you're in the unique situation of unfortunately having had a spouse pass away in this period of time where you had the $11.5 million credit and you filed for portability, it looks like this legislation would not change that. So your deceased spouse's $11.5 million would stay with you and be added to your $3.5 million under the current legislation. Also, a lot of the planning that's been done with trusts would be grandfathered, but you want to be really, really careful about anything you're doing this year because it's unclear yet from an estate planning perspective what of this may or may not be retroactive. This last bullet point here is affecting everybody. And probably among the most concerning of the items in the proposed legislation. So the step up in basis on inherited assets will go away if this goes through as written, which means your parents bought stock 50 years ago, its basis is $10,000, but it's worth $500,000. Right now, if they die and own it, you get it and you don't pay income or capital gains tax when you sell it. But under the new legislation, it would carry its original basis when you inherit it. So we're going to want to watch that one. That certainly will have an impact. And then businesses are in here too, and this is aimed at large companies mostly. So raising the corporate tax rate from 21 to 25 or maybe even 28, that's probably not as impactful because did you know 71 of the 500 companies in the S&P 500 paid zero tax in 2019? So companies really are finding tax loopholes to not pay. And this legislation imposes a greater of what you calculate when you go through the tax code or a 15% minimum, okay? That will certainly have an impact on profits. So I don't want to say that it's a non-factor, but it certainly seems ridiculous that you all as physicians are paying almost 40% on your income and the employers or the companies are paying nothing when they get through their loopholes. So expect some cleanup to double taxes on overseas profit and to make a bottom line no lower than 15% on corporate earnings. And I think the market is baking this in already and has digested it. You see the Dow 34,000. It seems like we're going to be able to digest parts of this bill if it comes to fruition. All right, so let's talk about you. And Emily's saying, keep it moving, keep it moving. This is looking at what you might want to think about personally as we approach some of these potential changes. Again, proposal, not law, but on your income tax planning, think about bundling itemized deductions. Giving a bunch to charity one year and then skipping it the next year is a good strategy. If you own a partnership or real estate, as I mentioned earlier, Emily and I would love to talk to you about how you can strategically plan around that for your retirement. As you enter retirement, Roth conversions might be very worth considering if you have a lull in your income between when you retire and when you start other income sources. If tax rates go higher in the future, getting your assets into a tax-free vehicle may be worthwhile. Optimize your portfolio to be tax efficient. Potentially take capital gains ahead of legislation. We call that gain harvesting. It's rare, but it does happen every few decades when capital gains taxes go up. We can help you think that through if it applies to you. New positive legislation on 529 college savings. They can be used now for K to 12, up to $10,000 a year. So if you have funded those vehicles for your children or grandchildren, we may want to think about funneling more money through there to help pay for their pre-college education. And if they're going to be medical professionals like you, of course, those can be used for grad school and professional programs beyond that. Estate planning, good year to have a good attorney and think about estate plans that you have created, whether they need to be reevaluated. And if you don't have one, probably a good time to start thinking about it because you'll be able to build it on the new rules. And you're going to need it with these lower lifetime credits on gifts and estate inheritances. And then for charitable planning, potentially using a donor advised fund or creating a charitable trust and thinking through from a business perspective if you're using the right structure for the future tax environment. C Corp, S Corp, LLC, partnership, there are nuances to each. And we want to think about planning for these qualified business income deductions. What is the best fit for you? So I will end at the beginning. If you remember nothing else, please think about the wellness approach to your finances, having a financial plan, covering yourself with an asset protection plan. And by the way, I will say this being married to a doctor, the best asset protection plan is a date night. Divorce can be a threat to your financial roadmap, and you all are busy and stressed out. So we put that on the wellness approach to personal finances and marriage. Set those little check-in meetings and date nights. And then making sure that your free cash flow is going to a combination of getting out of debt and investing over time. And please, 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 especially if you have kids, have that basic estate plan in place that says what you want to happen if you're gone. I'm not sure what the muting situation or chat situation is. I see 5 minutes on the clock. Would love to take a question or two if they're out there.
Yes, if you all have any questions for Rick, please use the Q&A function. I am not seeing any currently. So maybe if we just want to give everybody a couple of minutes back, and then if anyone has questions, can they just contact member service and we can get them connected with you all.
Well, thank you so much. I really, really appreciate being invited. I hope what we've shared helps some of you in some way. And we really, truly do welcome the call or email if you have any questions as individuals. So Emily and I are here to help you and really appreciate our relationship with you.
Great. Thank you guys. This was wonderful and a lot of information. And so we're very excited to get this on our website. Thank you.
Thank you all very much.
Thank you.
Great. Have a great day. Bye-bye, everyone.